Right then, good afternoon folks, and just another update from us at the end of another week of trading. We'll start with the calendar. A pretty busy economic calendar, one of the busiest economic calendars that you will see. Raft of central banks out over the course of the week, and then into today, labour market figures out of the US. We had a bunch of growth figures out of the Eurozone. From the end of the week, start of the week, Monday and Tuesday. Some inflation figures, some labour market figures out of the Eurozone on Wednesday. But if we just go back to the start of January and just have a bit of a think about the kind of major investment banks releasing statements and articles about the Eurozone avoiding a recession. We've obviously alluded to that in recent videos, but you know that obviously then needs to be confirmed by the actual figures. Now we've got GDP figures, as I said, out of a raft of different countries across the Eurozone. You can see here on just the high impact ones here, you got Germany, you got France, you got Italy, a number of other countries as well. But the Eurozone as a whole, as you can see here, the QOQ, the quarter over quarter figure, this is the flash estimate. So it's the first estimate you get for GDP, not the final figure, but you can be pretty sure that the flash will not be too far off. And then yeah, you can see a consensus was for minus 0.1%, so potential contraction in the Eurozone over the fourth quarter of last year. And you can see a surprise, certainly by the calendar's perspective, of a surprise expansion in the economy over Q4, as you can see, with 0.1%, albeit not that much, but it still avoids that contraction, which is important in terms of, or necessary in terms of, avoiding a technical recession. So a bit of positivity surrounding that. Straight into then inflation figures out of the Eurozone shows that inflation continues to cool down. The unemployment rate, labour market figure, slightly higher, but not too much higher, so nothing really to see there. Inflation is really what markets are fully focused on. And yeah, the jobs market going a little bit higher is not really too much of a negative at the moment, as we will speak about as we get on into the rest of the week. But then the first of the central banks, the Fed, 25 basis point hike, which was to be expected. That surprised no one. Markets were kind of anticipating a 25 basis point hike at this meeting, and then again in their March meeting, which that was what markets were kind of anticipating. But if you think about it on face value, I mean, you got to think about what actually went on at this time, and ongoing increases, they still were alluding to multiple hikes to then come forward. Obviously not that many. We are, whatever way you try and spin it, we are approaching the end of the hiking cycle. So whether we get one or two is a little bit undecided. They said they're going to still keep the foot on the gas. But then he started throwing around the word. I said Jerome Powell started throwing around the word disinflation. It's the first time he's really spoke about that in great detail, about the disinflation process beginning. He's been very firm in the last year, trying to come across hawkish in these statements, but in these press conferences, but he changed his tone a little bit on Wednesday evening, 7:30, kept mentioning disinflation. He mentioned the word a number of times, said that the process of disinflation is underway. That's really the first time we've heard that from him. He did suggest something else, that disinflation can happen if the jobs market remains strong. So you see come across today, non-farm payroll strong, the unemployment rate strong as well. So we'll talk about that in a minute. But in terms of ongoing increases, maybe interest rates slightly higher than the 5.1% that was priced, we might get up to 5.25, an extra 225 basis points after this, and then we might hold. Did say that they were not going to hike later on this year, which markets had begun pricing in. So in fact, they're not gonna cut. I think I said hike, but they're not gonna cut later on this year was what I meant. And the fact they're not going to cut later on this year, and they're still going to get more increases than markets were initially pricing in, that in itself is hawkish. But I don't think markets really care about that, to be honest with you. I mean, whatever way you try and spin it, they are approaching the end of this hiking cycle, and stocks seem to like that, and he seems to think that disinflation can happen with a strong labour market, which is what is going to need to happen, judging by today's figures. But we'll get back to that in a second. Then we're into the Bank of England, and pretty much sticking to the script with the Bank of England. A 50 basis point hike. You had two dissenters from the hike. You had one member of the MPC, the Monetary Policy Committee, suggest that push back, campaign for a 75 basis point hike in the last meeting. Did not have the same there. So slightly dovish in that respect. They are approaching the end of the hiking cycle. Some market participants thought that this was going to be the end of it, but they are probably likely to potentially hike again in the future. Probably not just quite at the end of it, but inflation is still at double digits in the UK. It's at 10.5%. which means you need to keep the foot on the gas. They did say that the inflation has peaked and it is cooling down. They upgraded their forecasts for the economy to show that the experience a shallow contraction in this year, which is better than they had predicted a number of months ago. So coming across, I mean, 1 point hawkish, 1 point dovish, and you kind of meet back in the middle. So not really a great deal to see out of the Bank of England. We know they still need to keep the foot on the gas, and out of these central banks, there's not really a great deal of information we could take off of this. There's kind of unchanged across the three major central banks. So not really too much we can do. Kind of off the back of that, we come around to the ECB. The ECB were slightly different though to the other two. The ECB back in December had alluded to 350 basis point hikes in a row. We got the first one back in December, the second one today. Oh, sorry, the first one today, the second one next month, and then another 50 basis points there after that. But what they said this time was that we get the 50 basis points today, get the 50 basis points next time, but after that, they will assess the situation, right? That is then dovish, right? That is then dovish. They'd be talking up rate hikes throughout the course of this month. They've been hawkish. ECB's not especially talking up interest rate hikes, and they need to keep the foot on the gas. And then, sorry. And then you come to the ECB then yesterday, and they kind of pour cold water on that, which is it's just stupid, isn't it? But you make a decision one way or the other. Don't communicate the markets the whole time they're going to do this, and then all of a sudden it comes around to the actual decision and the press conference, and you're like, oh, sorry, we didn't mean it. We're doing the other thing, which we're going the other way. Sorry, which is a little bit crazy, really, to think about it. But what can you do? What can you do? They will do what they do. And yeah, 50 basis points then at the next meeting. We'll assess the situation, therefore, after that. And then that comes across slightly dovish, right? It comes across slightly dovish, which is then weak for the euro, which we can see when we jump across over to the charts. And then we'll come back to Friday, into Friday today, and some wild trading today. We've got non-farm payrolls, actual 517k versus a consensus of 185. So what, 350, 340,000 jobs added above consensus, which is an extremely strong NFP report. You can see the unemployment rate come down to 3.4, down from 3.5 to 3.4, with a consensus of 3.6. So strong employment figures, whatever way you try and spin it. Last month's figure revised upwards as well, but that can be a bit of seasonality at play, with coming out of December, without out the Christmas month, coming into January, those can be kind of jobs added after the Christmas holidays and stuff. So strong, yes, but does it have longer lasting effects going forward? We'll have to see. And then you come around to the non-manufacturing PMI today, 55.2, right? Consensus of 50.4, and actual of 55.2. So strong figures there, right? Strong figures there, which is obviously strong for the dollar, positive for the dollar. Should be positive for the dollar, and then yeah, should be in terms of like normal markets, then should be kind of weak for stocks. But you come across the markets, and stocks have trucked higher off the back of that strong employment, right? They have continued this truck higher, from what markets interpreted as a Fed approaching the end of their hiking cycle. Which is obviously clear to see. But the fact that they said there's going to be ongoing increases, and disinflation can still happen with a strong labor market. Markets have just said, I don't really care what you have to say. Strong jobs figures come out today. Strong jobs figures means the Fed can keep the foot on the gas. Strong non-manufacturing PMI shows that the Fed can keep the foot on the gas in terms of rate hikes, and markets have just said, I couldn't care less what you have to say. And they continue to truck on higher. There's short bit of downside, after those figures at 130. but then it has popped higher and you're back through the pre-release highs. So, certainly interesting. Sorry, we'll just fix up all these charts, but certainly interesting kind of price action to then in the lead up to this American session. And obviously it'll be interesting to see how it close. Do make an attempt at that 4,200 round number. It is a solid level on the daily, and that will probably make people kind of rethink well, not rethink, the markets are long, but they'll probably make the bears rethink and think to themselves, right, is this thing turning around? But obviously we will have to see how that plays out. But what I'm getting at from looking at this is the fact that markets didn't really care what the Fed had to say on Wednesday. They are focused on disinflation. They don't really care about a strong jobs market today. They don't really care about strong non-manufacturing PMIs today. They're just saying that the Fed are stopping hiking interest rates and inflation is cooling down, and any time this dips lower, buy it at the moment. You can see the way this has been moving since over the course of this month. Every dip continues to be bought, and for now that's the side of the market I think you've got to stay on. Where it gets a little bit difficult, or where it gets a bit different, is then the dollar, right? And then the dollar, you've got what markets then interpreted as a dovish Bank of England yesterday. As you can see, this bearish candle did have a spike higher, but then continued to push lower over the course of last night and into this morning. Bit of a spike higher this morning, but then back into a move lower off the back of these strong figures. So the dollar has strengthened. Come across the euro dollar after a bit of a weak, a bit of a dovish ECB yesterday, what we alluded to earlier on. This then has continued to push lower over the course of today. It pushed lower yesterday and into yesterday's close, crossed this morning, had a little bit of a spike higher this morning, and then has had another flush back lower. Now I think this move is a little bit different to the move in stocks. The move in stocks higher is likely due to the fact that just disinflation is happening, and the Fed are going to stop hiking interest rates, so people are just getting long stocks. The difference with the dollar is it was a very, very overcrowded short trade. I mean, if you just look at the dollar index, we can get a fair idea of that just from euro dollar. You can see everybody just selling the dollar the whole way up here since kind of back in October, November of last year, and it's just been on a one-way train higher, and that's a very overcrowded trade at the moment. And when you get those overcrowded trades, what can happen is you get pretty strong aggressive pullbacks, moves back the other way, which is kind of a flush out of those shorts, kind of rebalancing of positions, which is needed in these moves. So it'll be interesting to see whether this actually is a longer lasting move, or whether it is just indeed a flush out of short positions, and then do you turn around and start pushing back kind of lower on the dollar once you've had that sort of retracement? Do you then attack the lows again, or on this one attack the highs up there at 110 on euro dollar and then push back higher? But you had a dovish ECB yesterday. You've got dollar strength then into today, off the back of some strong numbers. So maybe there's a couple of actual fundamental reasons. There's a technical reason up at 110 as well. So it's not a pullback just in the middle of nowhere, out of nowhere. There is reasons for this pullback. Whether that is longer lasting or not, we'll have to see. But I certainly think keep an eye on the dollar. How that results in the next week will be interesting. But certainly those stocks at the moment, every dip seems to be bought at the moment. That is a pretty overcrowded long trade as well. Stocks then pushing higher over the last number of months. That is a pretty overcrowded long trade. So I think if you do get a push lower in stocks, you could end up with a similar situation as the dollar. Very overcrowded short. You get a push higher, likely to be an aggressive move higher. If you get you get pushed lower in stocks, people are going to get out of those longs, and that is likely to be an aggressive move lower as well. So for now, dips continue to be bought. On stocks, definitely we'll have to see if this rally gets sold again on the dollar, but definitely some interesting moves in markets over the course of this week, and then into next week. I think we do get some opportunities in either direction. In terms of being able to predict them, I'm not even gonna lie to you, I'm not 100% sure really what direction these go in. I mean, I can see the idea for long. I can see the idea for longs on stocks. I have seen the ideas for long on stocks, as we've spoken about on these videos over the last number of months. With them being at the lows, stocks at a discount, 30% from the highs. That is a discount when they were at the lows, and then people jump in, buy them off the back of the Fed approaching the end of the hiking cycle. That is a reason where you can buy stocks, and reason when buying stocks is a good idea. But the economies do still have kind of headwinds. They do have interest rates now going to be above 5% in America. How does the economy perform under those circumstances is a question we've got to ask ourselves going forward. But us as traders, we don't need to look too long out into the future. Over the next week or two, over the next month, that's all we've got to figure out. And I think certainly buying the dips on stocks at the moment has been the theme over the course of this month. And why would you back against it? There's legitimate reasons for this pushing higher. But if it does turn around back lower and a bit of negativity does creep back into markets, that should be an aggressive move lower, and some short-term positions that way will be the way to play it then. So definitely some opportunities both sides of the markets, and we will have to see as we head into next week. Into next week then, have a quick look at the calendar. We've got the RBA out next week, another 25 basis point hike from them. Inflation still higher than anticipated for the Q4 reading of inflation, obviously quarterly figures in Australia. So we've got to see what the RBA have to say for themselves. Hiking interest rates, they still need to hike interest rates judging off those inflation figures. Some GDP out of the UK. The central bank did say that the economy would avoid a contraction in Q4. We obviously need the figures to confirm that. Consensus is for 0. Do we get some surprise growth? 0.2, 0.3%, likely to be positive for the economy. As of now, the UK is still the only major economy predicted to enter a recession at the moment. So why cable is up there or why sterling is strong, a little bit difficult to wrap your head around at the moment, but that is what financial markets do to you. Apart from that, not a fantastic amount out of the calendar. Next week, a little bit quieter of a week. Do have some inflation figures out of China, out of Germany on Thursday and Friday of next week. The labour market figures out of Canada. They have stopped hiking interest rates. They have gone on a pause. They're halting their interest rate hikes. So then it will be interesting to see the Canadian dollar. Does unemployment rise? Right, they're at the end of their hiking cycle. Does the unemployment rate rise? Do we get a surprise to the upside in terms of the unemployment rate? That is likely to be negative for the Canadian dollar. So a couple of things to watch out for next week, but certainly not as busy as this one. So that's it for me on a bit of a wild week of trading. Always fun in the world of financial markets. But yeah, have a nice weekend, recharge the batteries, and we'll be back next week to try and capitalize on some of these opportunities. So that's it from me then. Have a good weekend, and I will speak to you soon.